Hello everyone, I'm Brian Richardson. I'm the editor of LP Gas Magazine. In this video, I'd like to introduce you to Mark Rachal of Cost Management Solutions. I spoke with Mark recently about the negative price of crude oil. But, what was your reaction, Mark, to seeing the price of WTI crude at minus 37.63 on April 20th?
Well, there had been some experience to this. A few years ago, we actually saw ethane go negative. So I guess conceptually, you think, well, it can happen. But I don't know that you're ever completely prepared to see a train wreck. And that's basically what we were seeing. Crude had closed at $18.27 on Friday. So all day Monday, we were seeing that value erode. And you kind of look at it and say, gosh, I think we can get into single digits here. It's possible we're going to go to single digits. And then you do that, and it kind of held together to about the last hour of trade. And then all of a sudden, it just started going. And I got to tell you, when it went negative, it's one of those deals where you take your glasses off and clean them and hit on the side of your computer because you're just not sure you believe what you're seeing. And then, it's one thing for it to go negative, but to go, as a matter of fact, we went all the way to negative 40.32, I think, before it closed around 37. So, no, you're not prepared to see crude at minus $40. That's for sure.
Right. You talked a little bit about this as well recently, but can you explain briefly how that happened? What happened in the market that we got to that point?
It's a really good question, and we need to understand what happened to try to prevent it from happening again. Obviously, this is not good for the market, and it is a little bit difficult to explain, but I'll give it my best shot. So first of all, we have to understand the basis is in the fact that we've shut our economy down. That's the first thing. And what does that do? Well, obviously, refineries are not processing as much crude oil, and for example, we're processing about 4 million barrels a day less crude right now than we normally do. At the same time, we haven't slowed down our crude production. It's continuing to come along around 12.5 million barrels a day. It was, around 13.3, and it's come down some since COVID-19, but it hasn't really come down enough. So that's the foundation of it, that you have too much production for the amount of refinery throughput that you have. So you begin to fill up all of your storage locations. That's the foundation and the basis of it, but that's not actually what was the direct cause of us going negative. There are commercial players. There are people that are in the crude business. They produce it, or they store it, or they transport it, or whatever. Those are called commercial players. Then you have people that are non-commercial players, or you can call them speculative players. And these can be things like hedge funds, banks, and they go out and they also buy, and they provide actually an important function for the market to be able to have liquidity and move and that kind of thing. And one very large buyer of crude is Electronic Exchange Traded Fund, ETF, and called USO. And a lot of people point to the activities of USO as being the problem here. And what happens is let's say several months ago, these non-commercial players could have been buying crude. And it's really on paper. They don't have any way to actually physically take the crude. They're just really taking it it's just a paper position, a speculative position. And crude futures contracts settle at Cushing, Oklahoma. And you expect, if you buy those paper positions, that you will be able to have a physical player whenever it's time to settle that contract. They'll be able to take that position from you and actually physically take the delivery of the crude. So what was really going on Monday, it was just the 2 days before the May crude contract closed, expired. It would no longer be trading. So these positions that these hedge funds and ETFs and banks held, they had to be closed. And they had to find a physical buyer of those positions really in Cushing, Oklahoma. But Cushing, Oklahoma's storage is getting very near full, and refineries don't want it. So there was really nobody wanted this crude. There were no buyers for this crude. So suddenly you literally had these people that had to close these contracts that were having to pay people to actually take the crude off of their hands because they have no way. Again, these are people in an office. They have no way of physically taking the crude itself. So that's what really created the situation, and it just put a real squeeze on. And quite honestly, I'm surprised to see June crude doing as well as it is. I think we could repeat the same thing at the end of June unless, but 30 days is a long time. So the market has a way to adapt to these things over time.
Maybe shifting to the factors in the market. Obviously, COVID-19 we hear about a lot right now, having an influence. In over the years, you've analyzed a lot of different market factors. How big of a force is COVID-19 right now? On the market.
Well, obviously, on the energy market in general, it's a huge, and it's obviously the demand side. I mean, when you take an economy that's roaring and you just shut it down, and I'm talking about a global economy, it's hard to stop the ship in the middle of the ocean. I mean, things are still, you've got momentum, you got things happening, and nobody's really prepared for such a dramatic shutdown. So what we've done is we've just got a lot of oversupply here. As we've just shut down the demand, and then at the same time, really producers did not react fast enough and still aren't reacting fast enough to it. So really the situation is continuing. For example, right now, if you take what we're producing in the U.S. plus our net imports of crude, it's still outstripping what we're refining. So we continue to force more and more crude into storage locations that we don't have. So at some point, the producers have to walk out there into the field and basically start shutting in valves and saying, it's over, we got to shut it down. And it should have already happened, but they're hesitant to do that. So, but it's a huge force on the market in general. Of course, obviously propane has got a lot of impacts as well.
With everything that's going on, obviously shifting closer into our industry with the propane retailers, what can you tell them right now about the current market, where we are with conditions, what it means for propane pricing and supply?
Well, surprisingly, propane it's kind of a different animal than say crude and natural gas. From this standpoint, nobody ever goes to the boardroom and says, let's discuss drilling a propane well. It doesn't exist. So really, I believe my gut feeling is right now is that COVID-19 impacts will have greater impact on propane supply than it will on propane demand. Now, what has driven propane prices down so low over the last few years, it has been way too much supply for the amount of demand and the amount of exporting that we were doing. We actually had a net increase of 17 million barrels of propane inventory over the course of 2019. And we had gotten up to 110 cents on propane in October of 2018. And then this inventory build, because we didn't have enough export capacity, we started having a downward decline in propane prices. Even before COVID-19, though, we were beginning to see a little bit of erosion in the growth of propane supply, primarily because we were seeing an erosion in the drilling for crude wells. Why are we seeing that erosion? Most of our growth and production has come from shale formations. Shale formations, you have to constantly drill. The wells deplete rapidly, so you have to constantly drill. And investors were not getting any return from these companies that are in these shale plays. They really weren't getting any kind of real return. They've been investing in them for 10 years and still were waiting on any kind of return. So there was a lot of pressure already on these companies to start paying a dividend to their shareholders. And the only way they could do that is cut back on their capital expenditures, which is going to cut back on drilling, which is going to cut back on production. And so we were already seeing that. We were also seeing natural gas prices under $2 per million BTU. So you were starting to see a slowdown in the growth of natural gas production as well. So now a lot of our natural gas was coming associated with crude wells anyway. So if you shut down the crude drilling and the crude wells, you're going to shut down a lot of the natural gas. But natural gas in itself has gotten very cheap. Now you throw in the whole COVID-19 issues. So we were seeing downward declines in production. We were seeing downward declines in imports. We were seeing actually continued strong export rates for propane. So the fundamentals were already pointing to a potential upswing in propane pricing before COVID-19. I think COVID-19, again, is going to have more impact on the demand side than on the supply side than the demand side. So I really think it's going to be price supportive of propane. I think we're going to see an upward swing in prices this year, and I think we're going to see it anyway. I had projected about an 8 million barrel increase in propane inventory for 2020 prior to COVID-19. That would have been less than half of the growth in propane inventory of the previous year. And though it'd still be a growth and would have had us at record highs probably to start the winter, the trend, the fact that the inventory build trend would have been going down would have been price supportive. The market would have been focused on what was happening in the future. You take COVID-19, I made a few adjustments to my analysis just based on kind of what I thought might happen with COVID-19. Less production, continued exports, they're running high, and there's some things going on in exports that's making that happen. Perhaps even a little bit more retail demand because more people are staying at home and consuming more propane versus mostly we're shutting down industry and business, which consumes mostly natural gas. I just made a few adjustments to my model, and I went from an 8 million barrel build in inventory for this year to an 18 million barrel draw in inventory for this year. And I'm telling you, if we have an 18 million barrel draw, it's a totally different pricing scenario for next winter. So I think that the risks are to the upside at this point for propane pricing.